Picture this: you are standing in a massive warehouse and it's just packed floor to ceiling with products. The question, and the only one that IAS2 is literally built to answer, is this: how on earth do you put a single reliable number on the value of all that stuff? The objective of IAS2 is to prescribe the accounting treatment for inventories. This standard provides guidance on the determination of cost and its subsequent recognition as an expense, including any write-downs to net realizable value. It provides guidance on the cost formulas that are used to assign costs to inventories. IS2 defines inventories as assets held for sale in the ordinary course of business, in the process of production for such sale, or in the form of materials or supplies to be consumed in the production process or in the rendering of services. IS2 gives us one single really powerful principle that basically governs everything else: the golden rule of inventory measurement. If you are going to take away one thing from this explainer, make it this: inventories shall be measured at the lower of cost and net realizable value. Is the absolute heart of IAS2. Every single calculation and every decision you make comes right back to this fundamental rule. So what does this actually mean in practice? It means for every single item you have to compare two numbers. On one hand, you have its cost, which is basically what you paid for. And on the other hand, you have the net realizable value, or NRV, which is what you can realistically get for it. The rule is simple. You always have to record the inventory at whichever of those two numbers is lower. This is a super important accounting concept called prudence. It's all about making sure we never overstate our assets, because the last thing you want to do is tell the world your stuff is worth more than it really is. Now, let's pull that rule apart piece by piece. We are going to start with the first part: cost. We are going to dig into how we actually figure out the cost of an item, because you are about to see it is way more than just the price on the invoice. IAS2 breaks cost down into three main buckets. You have your cost of purchase, cost of conversion, and any other costs that were necessary to get that inventory to where it is and in the condition it's in. Let's check them out one by one. So what actually makes it into the cost bucket? That includes not just the purchase price, but any cost that was essential to get the inventory to its current location and condition. We are talking about costs like import duties and other taxes, shipping fees, handling fees, and any other costs directly attributable to the acquisition of inventories. If you are a manufacturer, costs will include your conversion cost, that is, cost for direct labor and a fair share of your factory overheads. Knowing what to include is one thing, but knowing how to exclude is just as critical. IAS2 is really clear about this. You cannot capitalize things like abnormal amount of wasted materials or labor. That is an expense for the period. Same goes for your general administrative overheads or any selling costs. And you might be asking, why is that? Well, because those aren't cost of getting the inventory ready. They are just cost of running the business and actually making a sale. Here is a classic problem. What if you have thousands of identical items, but you bought them all at slightly different prices over time? How do you figure out the cost of what you just sold? IAS2 gives you two main options. The first is FIFO, or first in, first out. FIFO just assumes the first stuff you bought is the first stuff you sold. The other method is weighted average, where you just calculate a single average cost for all your identical items and apply that average to each one you sell. The key is a company has to pick one method and then stick with it for similar types of inventory. So far, we've nailed down the cost side of things, but remember that is only half the equation. Remember our golden rule, the lower of cost and NRV. At this point, we need to do a reality check. What happens if the real value of that inventory has dropped below what we paid for? That reality check is called net realizable value, or NRV. NRV is all about estimates. Basically, you start with what you think you can sell an item for. Then you have to subtract any money you still need to spend to finish it. And you also subtract any cost to actually make the sale. Think about things like sales commissions. What is left over is the net cash you actually expect to get from that item. So what could possibly happen to make that value drop? Maybe the goods got damaged in the warehouse, or they've become obsolete, or maybe the market has changed and selling prices have just dropped. These are the kinds of triggers that force a company to do that comparison between cost and this new lower NRV. This shows you exactly how that rule gets put into action. If you calculate your NRV and find out the inventory is worth more than what you paid, you don't do a thing. You just stick with the original cost. But, and this is the important part, if the NRV is lower than the cost, you absolutely have to face the music and recognize the loss right away. You do this by writing down the value of the inventory on your books to that lower NRV. Up to this point, we know how to value the inventory while it is sitting on the balance sheet as an asset. But what happens at the moment it is actually sold? Where does it go then? Well, that's the last step in its accounting journey. The moment that item is sold and you book the revenue, something really important happens. Its value, the final lower of cost or NRV number, it moves. It gets taken off the balance sheet where it was an asset, and it reappears on the income statement where it becomes an expense. And this particular expense has a very famous name, cost of sales, or as you will often hear it, cost of goods sold. The last piece of this whole puzzle is all about transparency. It is not enough for a company to just do all these calculations behind the scenes. They have to tell everyone, investors, banks, and all other interested parties exactly how they are handling their inventory. So what exactly do they have to put in the notes to their financial statements? IAS 2 says they need to be really open about their accounting policies, like which cost formulas they are using, FIFO or weighted average. They also have to disclose key numbers like the total value of their inventory and, crucially, the amount of any of those write-downs to NRV they have recognized. That leaves us with a really big and, honestly, a really important question to think about as you move forward. The cost part of our rule is mostly based on historical facts, what you paid, but NRV, that's all about making estimates of the future. So think about it. Where in this whole process does a manager's judgment and assumptions have the biggest power to affect the company's reported profits and its financial health? Definitely something to think about. See you in our next video.